Advanced Financial Modeling, Topic 22, Cost of Capital. Section 2, Estimating the Cost of Equity using CAPM. While historical stock returns are observable, there's no observable or stated future rate of return for equity, and that's what makes it so difficult to calculate the cost of equity, the required return that the owners of the firm demand. Now, the standard model for estimating the required equity return is a model called the CAPM, the Capital Asset Pricing Model. CAPM relates the expected return of a stock to its market risk. So here's the basic rundown of this model, which has been discussed in earlier topics. CAPM, the model, assumes that stock investors are rationally diversified into many stocks, say the S&P 500. Therefore, the required return on any given stock depends on how it affects that overall portfolio, the market portfolio. This risk measure is called beta, and it's a regression coefficient, the slope, when you regress the stock's returns against the market's returns. Again, in the S&P 500 is usually used as a proxy. So looking at this Bloomberg screenshot, I have a regression or data point or our data plot here of returns of, say, Walmart against returns of the S&P 500. So on the y-axis here are the returns of Walmart per week and the returns of the market per week. So this data point right here says that Walmart had a 7% return that week and the market had a 1% return this week. Now, if I get the best fit line, that's going to be my slope of the best fit line is going to be called the beta. Now, beta 1 says that the stock market has about the same risk as the stock, individual stock Walmart would have the same risk as the market. In other words, when the market's up, say 10, the stock is up 10. Now, if you had a beta greater than 1, say the beta was 2, that means that the market's up 10, the stock market tends to be, if the stock market's up 10, the individual stock is up 20. And if you had a beta of less than 1, say 0.5, that says when the market's up 10, the stock is only up 5. So a greater than 1 beta means that stock is riskier than the market, and it's going to increase the overall risk of a portfolio. And if the beta is less than 1, if I add that to my portfolio, it's going to lower my risk. So beta becomes the key measure in calculating the risk of a firm and a diversified portfolio. And that leads to the CAPM formula. CAPM formula that says the required rate of return or the cost of equity for any individual stock, KE, is going to be equal to a risk-free rate of return. Why would you hold any asset that doesn't give you the risk-free rate of return, plus a compensation for risk? This second term is the compensation for risk. It's the quantity of risk or the measure of risk beta and the compensation per unit of risk. We're going to call it the market risk premium. That market risk premium is the expected return of the stock market minus the risk-free rate. So where do we get this data? The RF, the risk-free rate, the proxy for that tends to be the 10-year Treasury yield. Some people will use the short-term T-bill rate. I prefer the long-term Treasury bond yield because I consider an investor looking at stocks. The alternative would be another long-term investment. So that would be, say, 10-year Treasuries. So I'm going to take the 10-year Treasury rate plus my regression beta, which is the measure of risk of the stock, times the expected return of the market, say the S&P 500 in the future, minus, again, that risk-free rate. But generally, I'll just call this difference between the expected return on the market and the risk-free rate the market risk premium, also called the equity risk premium. So let's talk about where we can get some of this market risk premium. So it's obvious I can get the RF from just observing or just finding the yield on 10-year Treasuries, and I can run a regression to get beta. So how do I get the expected return of the market over risk-free rates, called the market or equity risk premium? So what I have here is some data. I downloaded from my Core Principles and Applications textbook. Also, this data is also available on the DeModern website. And what I have here are the returns of large stocks from 1926 to more recently, the return on long-term Treasury bonds, the short-term Treasury bills, and just for fun, I got the Consumer Price Index over the period of time. And what you see here is on average, large cap stocks, say the S&P 500, have averaged about 11 or 8% return, and long-term bonds about 5.5% return. And this is over that entire period. So over this 80 or so year period, 90-year period, the stock market, say the S&P 500, has averaged about a 6.16% return over bonds. So that's one place to start to look. If you think that the next, say, 90 years are going to look like the last 90 years, maybe I'll use about 6%. Now, what I generally see is most people use in a range of 4 to 8% for the expected return of the stock market over the bond market, or the risk-free rate, the long-term risk-free rate. And the reason why these estimates vary is because you'll use different time frames. Say if I only looked at the last 40 years or 60 years or 20 years, I might have a different estimate of that 4 to 8. As far as getting the beta calculation, you could simply download some stock returns. These are some monthly stock returns from 2014 to 2019 for Walmart. I'll go to my spreadsheet, and I have those returns right here. And I can just run a regression. Well, the easiest way to get the slope coefficient, or the slope of that regression, is not to run the full regression. I could just say equals slope, put in Walmart's returns, Control-Shift down, comma, and then I'll just put in the S&P 500's returns as my next variable. And I'll close that. So I got a beta for Walmart of 0.344. And if I want to get the R squared of that regression, if I want to figure out how much of Walmart's returns are explained by the market, I could just anchor all this cell. I'm going to select all that, hit F4. I'm going to copy that to there and change this slope to R squared, RSQ. And you can see only 5% of the returns are explained by the market, so maybe not that great a measure. The other way to do this, is I'm going to zoom out a little bit, is I could select this data, stock return, or the market and Walmart. I'm going to select that data, come back up to the top, and I'm going to insert a XY scatter graph. I'm going to then do a right click, add trend line, and display equation and R squared. Close that. And there I have my best fit line. There's my R squared. Looking for the equation. There's my equation. And there's my equation there. It's 0.3439 or 0.344. And so this is how you can get the beta of a stock, the downloaded returns. Now in theory we should be subtracting the periodic risk-free rate from both these, but it's common practice from my experience is to sometimes just drop that and not do the regression of excess returns of the market and excess returns of the stock, and has very little effect. But in theory, we should be doing that. We should be subtracting the periodic rate of return on, say, bonds from both of these. So, got my beta of Walmart of 0.344. At the time of this analysis, the long-term, or the 10-year Treasury rate was 1.95%, and I'm going to use that 6.16% to be the expected market risk premium. So I'll take my risk-free rate plus my beta times my market risk premium, and I get an expected return, or CAPM return, for Walmart stock to be 4.06%. But remember that R squared looks lousy. So let's do a little more discussion of beta and what causes beta and how beta is affected by debt. So you think about, why would a firm have a higher or lower beta? So again, let's define beta. Beta is a measure of the relative sensitivity of a stock to the market. So again, a beta of 2 means that the stock is up twice as much as the market, or twice or half as much, or twice as much as the market if the market's up or the market's down. So it's just more sensitive. It's riskier. So why would a stock be riskier than the market? Well, the number one reason would be cyclicality of revenues and profits. So high cyclicality, let's think about luxury or discretionary goods. So I think that the beta of a company that sells Rolexes would be very high. On the other hand, the beta of companies that sell, say, drugs or just consumer goods that you need in good times and bad, they would have low betas. Also, if thinking about stores like Walmart, I would think that a discount retailer would have a lower beta than, say, a high-end fashion retailer. So that's the first reason. You have cyclicality of your revenues, and relates to whether you're a luxury or discretionary goods seller or maybe a consumer staple seller. Another reason might be operating leverage. Say you produce your goods in such a way that you have lots of fixed costs. If that's true and you sell a lot more, your unit costs are going to fall and you're going to get a lot more profitable. And if times go badly, your fixed costs are still there and you're going to do really poorly. So firms that have high operating leverage, use a lot of fixed cost in production, are going to have a higher beta. And the last one is financial leverage. If you finance your business with lots of debt, you have a lot of fixed cost in production, fixed cost in financing. So when times are bad, you still have to pay these fixed expense. When times are good, however, those fixed expense are fixed and times are even better. So let's ask a theoretical question. What is Walmart's beta if it had no debt or maybe twice its debt level? So I'm going to accept the first two arguments and let's try to figure out what's the net effect of debt on Walmart's risk. Now, the unlevered betas are computed by delevering the regression beta, or also called the equity betas, by the firm's DDE ratio using the market value of equity and our net debt to basically strip off the financial risk. So for example, if Walmart has a net debt of $66 billion and a market cap of equity of $340 billion, my DDE ratio is $66 billion over $340 billion, and my formula for unlevering a beta is to take that regression or levered or equity beta. I kind of use those synonymously also. So I'll call that the equity beta or levered beta, or sometimes just regression beta. I'll take that equity beta and divide by 1 plus the DDE ratio. So I'll take my 0.35 I just estimated on the last screen. I'm just kind of rounding that. And I'm going to divide by 1 plus the DDE ratio. And if Walmart had no debt, its beta would go from 0.35 to 0.93. It would just be a safer firm. Now, we can also adjust the beta to see if they had more debt. So what if Walmart had twice the debt? Okay, so we could just take that unlevered beta and multiply times 1 plus the DDE ratio. So again, take an unlevered beta times 1 plus the DDE ratio, and that would be the new levered beta. So if I take their unlevered beta of 0.93 and multiply times 2 times their DDE ratio, I doubled their DDE ratio, Walmart would have a beta of 0.4067. So it's key here to see that an unlevered beta is a levered beta or an equity beta divided by 1 plus the DDE ratio, or reversing that or solving that equation for beta levered, the levered beta is the unlevered beta times 1 plus the DDE ratio. So this leads me into a discussion of something called an industry beta. So regression betas are notoriously unstable and explain very little of historical returns. Remember the 5% R squared on Walmart's beta. An alternative is to use the beta of an entire industry to capture the underlying business risk that participants face in that industry. Now, industry betas are available at Determinants website, and we'll go there and take a look at the data. If I go to Determinants website, I can see unlevered betas by industry, and you can see some of the highest betas I have here in red are chemical, computers. Some of the lowest beta here is financial services, believe it or not, farming. Really high one there is railroads, transportation. So if I were to look for Walmart, I'd probably look under retail, general retail, 0.75, retail, groceries and food, 0.28. So that's kind of Walmart's neighborhood. They're kind of in both of these business lines. So what I can do for Walmart, since it's kind of two companies in one, I can say Walmart is roughly 50% of its revenues from grocery and 50% from general retail. So I can take 50% of the 0.28 beta for grocery, and 50% of the general retail beta, we'll say 0.75. So I can say Walmart has an industry beta of 0.5150. Okay, half the risk of the market. However, this would be the beta, since I used unlevered industry betas, this would be the beta of Walmart, or any firm that has 50-50 of those two industries. This would be the beta of those firms that had no debt. However, what I'm going to do, I'm going to capture the business risk of the industry, capturing cyclicality and kind of fixed cost in production or operating leverage, and I'm going to layer onto that Walmart's financial risk. So if Walmart had no debt, it had a 0.515 beta. However, I'm going to multiply that times the DDE ratio and get 0.615. So my Walmart cost of equity is going to be 1.95%. My risk-free rate plus the industry beta levered up for Walmart's debt and multiply times 6% to get to 5.64%. Now, industry betas are the preferred estimate for firms with unstable betas, meaning they're changing all the time, or changes in leverage. Say the firm just recently delevered or increased their leverage, so the historical data regressions are no longer useful. Also are used for private firms. So if you're going to launch a brand new Walmart that's a private company, I would use something like this with that firm's DD ratio. Also, or just if I calculate regression betas, I'm getting those regression R squareds of less than, say, 10-20%, I'll just default to an industry beta. One caveat, a formula you may have seen before, when levering and unlevering betas, you may have seen that you'll multiply times the DD ratio times 1 minus the tax rate. So that's an alternative model, and you can look into that. It has to do with whether or not you believe that the interest tax yield has a beta of 0 or not. So it's a rather technical issue, but there's two ways of calculating the after-tax or the levered and unlevered betas. The other alternative is to multiply the DD ratios here and here by 1 minus the tax rate. So in this topic, we estimated the cost of capital using CAPM. We used a regression beta. We then talked about how to lever and delever a regression beta. And we also talked about how to use an industry beta, industry unlevered beta, and levered up for a firm's cost of debt. Now in that last example, we got that levered industry beta for Walmart at 0.615. So if I plugged in the if I plug in the risk-free rate plus the market risk premium times that beta, in this case, I'd have a Walmart cost of equity of 5.64%.